Where did this framework come from? Is this a finance textbook or is there a deeper story? The story is actually quite simple. I've done about 5-6 different ventures depending on your definition. My first was something called Avicina. And Avicina was an edtech startup that basically sold corporate finance training to analyst and associate training programs on Wall Street. My second business was a risk tech business. We sold risk technology to the banking industry in Pakistan. There is a space that's called GRC. It's called Risk, Governance and Compliance. So governance, risk and compliance. This was one of the hottest space. Right now today, and remember this was 2003, 2008. Right now today, this would essentially be qualified in the fintech space. Then I tried my hand at publications, actual physical print publication, because I thought there was an opportunity. Then we did something called Learning Corporate Finance, which was basically renewed edition of the original Avicina, and then we did financetrainingcourse.com. So I've done, I'd say, live startups that I'd spent more than 2 years on. This was about 2 years. This has been about 20 years. This was about 10 years. And when I worked on these ideas and teams, I spent a lot of time thinking about them. Avicina, the business, did not do well and failed for a simple reason. It failed because there was a single core focus. There was no repeat purchase. Alchemy was a business that did very well for about 5 years. And these 5 years were basically from 2003 to 2008. But then we hit a big wave of consolidation. So when the great financial crisis happened in 2008, most of our customers got acquired. And if you're selling technology to an industry that is shrinking, in the sense that the customers that you work with are being bought out and acquired, where there is going to be intense pressure on margins, where the growth trajectory is not linked to your product, then there is limited incentive for customers to buy your product. Here, there was no repeat purchase, so the underlying model was broken. Here, the underlying industry was growing, so the banking industry has grown, but that growth path was not linked to what we were doing. And this is a really important consideration. Remember I said, how do you grow that industry 10x? You want to identify the path of growth for that industry, and then you want to make sure that you're in that path. And if you're in that path, as the industry grows, you will also grow. So the banking industry grew over the last 10 years, but we were not in that path. We were not in that path because we hadn't done that analysis. FTC financetrainingcourse.com, basically builds high margin, low volume products. Here again, the biggest challenge is it's a small market, it's a niche space. And that niche space, because it's also linked to banking, is not growing. So growth becomes an important consideration. When you look at growth, once you identify a segment, then you have to answer 3 more questions, right? The 3 questions are motivation, monetization, and traction. Answering these questions is important because they translate directly into the model that you're trying to build. If you think in terms of investors, how do investors assess and value opportunities? There are filters that they use for idea selection, and the first filter is margins, profitability. In the space that you're working in, where are margins today? Where will be tomorrow? Where will they be 10 years from now? So if the underlying industry is growing, we know for a fact that the industry will be there. And as long as we understand what that path of growth is, then we can make sure that we build products that would be in demand on a regular basis. Second path is customers. What do customers look like today? Not just in terms of profiles and attributes, but also in numbers. Where would they be 10 years from now? More importantly, how would acquisition costs for those customers change over that time frame? Third piece is relationships. Relationship between you and the customer, your product and the customer. And these are pieces that we've always spoken about. Purchase frequency, shelf life, retention, churn, profitability, and most importantly, the life arc of that customer. How is that customer going to grow and change over the next 10 years? How would your product fit in that story over the next 10 years? Will you just use your product once and throw it away and shelf it? Or will you have a role to play on a regular basis in that story? And then finally, markets. Where are markets now? Are they hot, cold, warm, or dead? What's the growth potential? How many active investors are there? Who's interested in buying in? Who's interested in selling out? What's the context? These 4 components: margins, customers, relationships, and markets. These are 4 questions investors look at, 4 filters, 4 screens 4 scoring sheets that investors use to decide whether they should have a more detailed conversation with you or not. And then you sort of get to the second or the third or the fourth round. Your models need to answer. Your models need to relate. Your models need to be relevant to these 4 filters. What you really want to solve for, not just at a business level, but also at a model level, is value. You need to answer very clearly. Your model needs to show very clearly how is value created and generated. Second part is traction. How do you get to traction? So if I go back to the 3 examples I spoke to you about earlier, Avicina, Alchemy, and financetrainingcourse.com, what were the challenges? Avicina, biggest challenge, low purchase frequency. Alchemy, biggest challenge, number of customers were shrinking, and more importantly, in the growth arc of the customer, we had no role to play. There was no connection here. FTC, small number of customers today, small number of customers tomorrow. Not going to grow. So there is no growth feeder here. And then from a market point of view, the edtech market was very hot 20 years ago. It's very hot now again. But the space that we were working in had limited growth potential. With Alchemy, the risk tech market, the GRC market, the banking market, the financial services market was all very, very hot. But because we didn't have this connection, we weren't hot. With FTC, market wasn't big enough. The reason I've spent this much time on setting this context, and the reason why I'm covering this in a financial modeling workshop, is because before you build a business, it's always better to build a model. Excel is cheaper than real life. But before you build a model, you have to think, what is this model about? What's the backstory? And the backstory is a function of filters that investors use to invest in the business that you work on.